Here we are. I'm with the man, the myth, the legend, Tal Schwartz, AI Funds. It's good seeing you. Second time
Good
we've
to
met.
see you. Good to see you too,
Uh,
Mike. Thanks for having me.
Absolutely. Um, my name's Mike Lynch. I run Lynch Financial Advisors. Been doing that 25 years. Tal, how long has AI Funds been around?
We launched I Funds in 2019, so it's about a little over 5 years.
I thought artificial intelligence just came out like 2 years ago.
No, it's been around for a while, actually. I've been working on aspects of machine learning and AI for about 30 years. So it's been an area that's been under research for a long time.
Yeah.
And I found that there's an opportunity there many years ago, actually, when I used to work in hedge funds. So it's not something new. It's now in consciousness, public consciousness for the last
Yeah.
2 years.
When I was digging around and like searching to find to find you out there and different little videos you did. One of the what videos you did, I don't know if it was with your wife, like in front of that casino. I think it was in Florida.
Yeah.
Um, and and this is why I was like, I'm gonna like this guy because I'm a game guy, and you're obviously a game guy as well. It's like, okay, what are the puzzles here, and how all the pieces move and work? And if I could figure out how they all work and move, I might be able to get this to operate better, faster, whatever else. And that seemed to be a little bit of like what you were kind of getting at in that what you were talking about in regards to the casino. What was that you were trying to do there?
Oh gosh, that was a long time ago when well, the video was about, I don't know, 5 or 6 years ago, but the idea was something I did when I was, I think it was in high school or actually in college. And the idea was there's a game called Highlight, and I grew up in southern Florida, and you could gamble on Highlight. And I built a simulation basically that played lots and lots of highlight games to try to figure out if you can win, betting on trifectas and things like that.
Yeah,
So I was looking for an edge
yeah,
back in the day. I was using, much simpler computers than what we have today. But the idea is similar to, you know, maybe what AI funds is doing today in the stock market. But the idea is similar is can you find patterns? Can you find regularities in the way the game is played that you can take advantage of and actually beat the house in a sense?
yeah. Um, Go. Was it not? Was it AlphaGo? Um, which I did, and I thought that was fascinating, just of how well one, like you think. I always think about computers in the terms of okay, if we just stack enough together, can't they like beat whatever? And the reality is no, right?
No, it's the reality is no. So I think maybe it's a little bit of a background. There's actually two types of AI. There's something called narrow AI, which is good, which we train and get it to be good at solving specific problems. And there's general AI or broad AI, which is good at kind of doing everything. What's been in the news in the last 2 years has been the general AI, the ChatGPT type LLMs, large language models that can pretty much seem to talk like a person and respond to us. So that's the general. But that we've had actually more success before in the last 30 years with the narrow AI. So in the movie Go, what the AlphaGo team was able to do is build a narrow AI that played Go better than the best player in the world. And since then, they've improved it. Now they have something called Alpha Zero. It can play better than AlphaGo. It's actually better than, by far, much better than the best player on the planet. And we're actually learning from it new strategies and how to play the game better. So the narrow AI is where we've had the most success for the longest. And when I started AI Funds, the goal was to build a narrow AI, and that's what we've done, that plays the game of investing better than the best human.
Mm,
So that's the idea behind
yeah.
there.
So is it? I mean, is kind of the idea? I mean, maybe now is actually a good time to kind of get into that world of AI. So, um, give me like a simple kind of way of thinking about the broad and maybe some contextual around that, and the same thing with narrow.
Okay. So with broad AI and what the chat GPTs of the world do, they take a lot of data, and pretty much all the data we have on the internet. They've digested most of everything. And then they find with very large neural networks that kind of imitate the way our brain works, but they work differently. They try to find all the relationships between all that information so that at the end they can think of it as they try to some people say it's autocomplete the sentence. It's much more than that. And what they've been able to do, and this has actually been a surprise to a lot of people, it's how quickly we got there, because it wasn't expected that we'd get to the level that we are now. Just 3 or 4 years ago, this was not unexpected, so it was a big surprise that all of a sudden when you do this and you scale it up, all of a sudden you get this actually intelligible conversation that you can have with this chatbot. So that was a surprise, but it's kind of an emergent property that once you have enough processing power and enough data to train it on, you get this effect. So it was surprising to us. What we do with the narrow AI, we actually build algorithms and systems that are designed to play or do a certain task as best as it can. It still uses a lot of data, but very specific data for the specific problem that you're trying to solve. Okay. So, in the game of Go, basically the first versions were trained on millions of games of Go that humans played. Okay. That what it was trained on.
Right.
Then they got the system to play against itself, and it played billions of games. In fact, it played more games that humans have ever played in the history of humanity, and it learned things that humans have never even seen. There were some moves that Go does now that humans are like, "What? That doesn't make any sense. It looks like a mistake." In fact, in that game it played against the world champion Lisa Dahl, there was a move it did, a move called number 37. It's a famous move where it did something, and all the experts scratched their head and said, I guess it's not that smart because it
Right.
just made a move that seems like a mistake. And then, 10 moves later, they're like, oh my gosh, it's winning. And it's winning because of that stupid move it did, or the
Yeah.
move we thought was stupid. It turns out that was a brilliant move that we've never thought that would make sense in the game of Go. So it's seeing things and it's finding patterns that we could never find before, and
Well,
it's doing those things in a way that gets that it's teaching us how to play the game better. So the narrow AI we've actually been better at for longer, and now the broad AI is catching up. But it's still, if you look, there's a famous paper. I should just, I'm actually, I did some analysis in this, and we're going to have a future newsletter on this from Google. It came out in June, where they try to, it's Google DeepMind, so the guys who were behind AlphaGo and AlphaFold, which figures out how to fold proteins. So they did this paper, which basically gives you a way to think about AI. So there's the first, they divide into two categories: narrow and broad. In the narrow, there's 5 levels. Zero means no AI. And then one, you're just emerging. And two, it's like you're about average human. And then it keeps going. Level 4 is better than 99% of humans. Level 5 is better than every human. And you can see that we've been able to go to level 5. We have AI today in the narrow side that's better than any humans on the planet. And that
so
includes the Alpha
just for
Zero.
clarity,
Yeah.
like you're saying in that narrow side, like if you were to say, okay, we're going to take a sleeve of a category, right? And I don't know, like I don't know, I'm trying to think. Okay, Go, like the ability to be able to play this game. That would be a
Yeah.
sleeve in that category. Now, outside of that space, it might move down to a 3, 2, or a 1, or it might not even exist
Oh,
that much.
if you look at the broad, the general category that where the
Yeah,
ChatGPT sit,
yeah.
they categorize that at level 1. Okay,
Okay,
so
okay,
in the broad one, we're level 1. Maybe now we're getting to level 2. Maybe with the new
okay.
models are coming out. Some people say that the Claude from Anthropic, which I use, maybe
Yeah,
that's level 2 already. Uh, but it has to be very good at many, many, many tasks. It's not quite clear what that definition is, but maybe it's at level 2. So in the narrow, we're like better than every human in some aspects. So playing the game of Go, folding proteins, playing chess. Okay, we're better
yeah.
than every human. We have a program called Stockfish, which is, if the best human on the planet, the best player on the planet is like 2,800 elo, Stockfish is 3,800. Just to give you a sense, it's like 1,000 points higher.
Okay.
A huge difference. So the best human does not have a chance to
And
win
that's all
against
in that narrow, like,
narrow.
because, and so is that because what's happened in that narrow space, and obviously I'm simplifying it, but it's, I, I would think that you are limited by the amount of processing and data in that, like some sort of a metric or combination of the two, of like how much information can something process at a given time, and how many locations can it go to seek that different set of information? Is that am I anywhere close?
It has more to do with the task that you're trying to solve.
Sure.
If the task has very defined rules, if it's a game with rules, then
Yeah.
we can program that into a computer easily. And we can then have the computer play itself and figure out how to beat and how to become really good at it. And it could generate a lot of data just by playing itself. As soon as you don't have clear rules and things are more random,
Mm,
then that problem gets harder. And when you talk about human conversation, for example, what we're having right now, that's an extremely hard problem because this conversation can go into a million different directions, and you can throw something at me out of left field, and I should be able to think about it on the fly and reply.
right.
Really hard for an AI or any program to do that. Not for something we can. It's not something that we humans can program on our own. However, if you put that into a large neural net that can learn all these patterns, eventually you will figure things out and figure out how to answer anything that you can throw at me. And that's what ChatGPT does. Okay. It's still not perfect. It still fails in, all these models, they fail at very basic things. Like there's some really simple ask things you can ask it and it will get it wrong. Like right now, a famous one that's going around, you ask a model, what's bigger, 9.9 or 9.11? A lot of them think that 9.11 is bigger. Now, that's something
Interesting.
you can ask a kid
Yeah.
and they would get it
Yeah.
right, right? So this basic stuff it gets wrong, or basic logic, or things that are very intuitive for us as humans. The models still are not there.
Yeah.
So it's they're getting there though. I mean, it's they keep releasing new versions. So we're on ChatGPT 4. There's rumors that Strawberry, the next iteration, is coming out now, and there's 5 or whatever it is. It's all going to get improved over time. So the level of growth is quite fast. So I would not be surprised if they get to a point where they're as good as the average human, maybe even better than the average human. So level 2 and 3, we might get that very soon, but not there yet for the general models. For specific problems, I mean, there's so many problems where computers are
Well,
better than us. I mean,
I think, let me, if I can, I
yeah,
just want to, um, because some of the terms that you're using, I think, are key to those of us that don't live in the space to understand it better, right? And
okay.
you're throwing out the word models, right? And so maybe just take a step back and like, okay, what are these models that you're talking about? You mentioned a little bit of the building back end algorithms, but there's something else in there, right?
Yeah, well, I mean, okay, so what we've done in both narrow and broad AI essentially is build. You can think of it as model or constructs inside the computer that are either designed to solve a very specific problem, which is the narrow AI, and this could be anything from playing a game like chess, or figuring out how to optimize a portfolio, which is what we do, or it could be a very narrow domain that the computer can get very good at solving these
Right.
problems. Okay, and it's not and every one of these problems have very defined characteristics that you can define and then have the computer figure it out by searching a very large space of solutions, things like that. So the latest one that was solved, Alpha, the same team from that did the Alpha Go and Alpha Fold, just started figuring out how to do mathematics really well. And this is exciting because they were able to get to a level where there's a competition called the Math Olympiad, where the smartest people on the planet go to the best mathematicians to go and solve math problems. and it got to almost a silver level, almost a gold. The gold is like the top, 0.001%,
Yeah.
but it got to a silver level. So it's very advanced. Like that's a high level of math, solving math problems. And the reason it's impressive because it's seeing problems it's never seen before. So it's able to be creative the way mathematicians are to solve these problems. So that's impressive. So it's a very specific area. But then when you start,
So in that, like, I guess the question is out on that model. uh, So like, in a portfolio, you're thinking about. It's fairly simple to think about. Okay, optimize this for maximum return or for maximum return relative to a certain drawdown. Like you can put
yeah,
different pieces in there. But to what you're talking about, if you have some math problem that's not like a 2 plus 2, and to your point, it hasn't been put in there. That's different, right? Like because you can't tell it what to do per se.
yeah. So exactly. So what they do there is they have a combination of it's a combination of neural nets and other algorithms where essentially it's looking at how humans have solved many of these problems in the past, and it's seeing patterns. So it sees, oh, okay, so sometimes so there's some, you can call it patterns that it could try. There's probably like hundreds of different patterns, and given a problem it can try different patterns, but now it can try them very very quickly. So while a
Yeah.
human has an intuition, it sees the problems, goes like, I've seen this one before, and the way you usually approach it is by doing this how you drop the line from the top where it's a geometry problem, and you figure out the right angle, and you do this and that, right?
Yeah.
Because I've seen this before. The computer's also seen it before, but he's seen many many others. And then he might say, I'm going to try this and that, see which one kind of gets me closer to where I want to go, and it's trying many more things than humans. So when we first solved chess, it was pure brute force, right? This is back in the what was it, 80s, 90s. It was IBM Deep Blue. It was just beating Kasparov by just trying lots and lots of things. Okay, lots. It
Yeah.
was basically looking ahead in the tree of the problem with playing chess, for example, and also Go, is that the tree grows exponentially. As soon as you do one move, the number of possible moves is huge because there's so many squares on the chessboard. So it grows very very fast, and it's really hard to search all that tree. What Deep Blue did is just had like just an immense amount of hardware to search deeper than Kasparov could, and it could see a little further ahead, and that's why it was able to beat him. What we do now is we're doing much smarter things because we don't have to search the whole tree. We search only the paths that are most likely to win. It's still a search, but it's much smarter, and as a
And
result, it goes deeper into the tree.
is that something that
Um,
you program into it? Like you go back in, or you teach it, like, look, you don't need to go down all these avenues, right?
yeah, so today they teach it. So today they also use a neural network to do that. So it's
Okay.
a combination of a lot of So back when they first, when the first chess computers came out, it was more brute force. Now it kind of learns on its own some techniques, some patterns, and when it tries things, just like solving the math, it's the same idea. The idea is it learns patterns and then it tries different things to figure out how it's going to work. And so it's that's the way we kind of do it. And in some sense, it's similar also with LLM models but the LLMs, it's much more about learning these patterns, and you still need a tremendous amount of compute. And when you say the word compute, basically just think of it lots of computers. Okay, it just
Right.
basically means we need a lot of computers, and that's why right now there's Nvidia has gone up like 10x in the last 2 years because they're providing the GPUs, the graphical processing units that we use for this type of compute. And every company out there, well, it's the big ones, but also every company out there wants to get access to these GPUs because we need them, and we need lots of them, especially if we want to build the next level of models. So yeah, so I don't know if your audience is aware, but they're talking about building clusters of GPUs that are going to cost not billion, but like $100 billion. I mean, that's like the kind of size of compute that you need to build this. So it's almost like the sci-fi that we used to talk about, but it's now becoming real because the value that it can create is huge for humanity. It's huge value. People underestimate it still, I think, in my opinion.
So go back because I feel like there's a foundation I want to build a little bit, right?
Okay.
So um, we've got an understanding of algorithms fairly simple, right? Like I think we've all heard the term, and it's not that far to get into. But when you say like neural network, right?
Yeah.
Like now, what is that? Like what I mean, you think of the mind and like all the little things in there, but what
Okay.
exactly? What is that?
Okay, okay, good question. So let's start with the basics. So I worked on neural networks back in the 1990s, just to give you a sense. So
Yeah.
it's been around for a while, but back then the neural network was really simple. What does it mean? It was basically you had a node or a few nodes where you can enter signals, and then there's another few nodes below that, and another node, another set of nodes. So it's three-layer neural network. What does that do? Basically, you can enter some inputs and there's some functions, and the idea was try to imitate the way the brain works. And back then we figured out, oh, how neurons work, and there's certain basically there's like a chemical reaction happening, and when you excite a few of these nodes, they excite the next ones and they excite the next ones. And at the end, you get some result. And the idea is it's kind of like doing a computation on the data. We were able over time to get it to do things like recognize images, basically being able to say, oh, if you get these excitations, then, that's, the letter A or the letter B, and you were able to teach the neural network to do that. And over time we figured out, oh wow, this neural network, rather than trying to give rules, because when you try to identify handwriting, turns out that was a hard problem to do. You could use a neural network or some other machine learning tools to identify handwriting, and we solved that problem. And we're able to now very high accuracy figure out, when someone writes something with their handwriting, what does that mean? Okay, so that's an example that we solved with neural networks and other techniques in machine learning. The idea of the neural network is basically think of it as a way to take some inputs and then come do a bunch of processing on that to get an output that tells you what some output you're trying to figure out. And the way you train that neural network is you tell it, oh, see when someone draws an A, and if the neural network guesses an A, you give it a reward. You tell it, good job. And the neural network is trying to maximize the reward. It's basically trying to get the most rewards it can get, and the least, so the most rights and the least number of wrongs. So if it's an A and it says B, then okay, that's wrong. We're gonna take some reward away. And if the neural network essentially is just trying to get as much reward as possible, then it's just going to eventually figure out what an A is. Okay,
So
so that's
it,
sort of the intuition behind it.
it sounds like it's a learned database of information. So like you're basically training, you're utilizing a certain set of data that come in there, and then you're training. It's like you've got a bunch of puppies, and now you've trained all these puppies of like, here you go, eat this, don't do this.
Kind of, but now, but the way, but it's all based on math. So you have weights on these different connections between the neurons, and the idea is that once you know what these weights are, the optimal weights, you will always classify as A as an A and a B as a B and all the letters of the alphabet. So once you figure out that neural network that does that classification well, you've solved the problem. So that's the idea. And that's a simple problem. Now, what we figured out is wow, you can make this not just two or three layers, you can make this very deep and very broad. Today's the LLMs we use today have billions and trillions of parameters, like a huge number of parameters. So they're huge models, and they've learned the relationship. At first they learned the relationship between language words, what how one word is related to another word, and how they should go around in a sentence. And now they've made them multimodal, and that's a complicated word, but basically means not just language, not just text, but also vision and also audio, and pretty much every data that we can get any data source we could get, they can train it on it and have it inherent in the same model. So in a sense, what they're trying to essentially emulate is a human brain, because the human brain is multimodal, right? We have these, five senses that we work with. It's not just sight or sound. It's touch, it's smell, whatever. We haven't done as much touch and smell yet, but we're getting there too, because now we're putting these models inside robots. So the robots are going to navigate the world and are going to learn through the senses the same way humans do. So we're essentially building. I mean, this is sci-fi kind of, but we're building an artificial brain. Okay, but it's not the size of our brain. It's huge. It's huge data centers, right? They're gigantic and they take a lot of energy because we haven't figured out how to do something as good as our brain yet. Okay. So our brain runs on
Which,
very little
which
power and it's very
that's
small.
just that's a fascinating, kind of thought of like how complex our brains are, and and yet, how much we're over here on this side, we're like trying to get there. And I don't know, there's a lot of what is it, theological, spiritual components in there that you start to really kind of wonder.
Yeah, well, I mean, it really talks about how efficient our minds are compared to what we're doing today. What we're doing today, it's version one of AI. It's not very smart. It's not very. It's extremely inefficient because you think about how much power and how much silicon we have to put in there to get to the level of
Right.
of operationability that starts to approach what we're doing. It's pretty amazing. So you get much more appreciation for the human brain when you look at it. But the beautiful thing about the AI is that once we get to a level where we're close to human or about human or surpass human in some areas, that's replicable. We can replicate that as much as we want. So that's why it gives us so much value, because essentially gives us superpowers, because every single person, one of us, can now access ChatGPT and make our writing better. Okay.
Right.
So and that's the thing that's amazing about it. So while we have this amazing, very efficient superpower that all I have to do is eat a little food and drink a little water, and I'm my body's running and I'm able to access it, will be everybody can access this external one and become smarter in some way. Okay. So or make us more efficient in many ways. So that's kind of, if you think about the whole computer evolution over time, I mean, that's what computers have done for us. I was a kid when the first PCs came around, and I got to play with the early ones and program them, and that was a lot of fun, and I could tell how that was going to make you know create an improvement. And then we got another bump with the internet. Well, now we're getting the next bump with AI.
Right.
Okay, in terms of our efficiency.
So let me change gears a little bit. So if I remember kind of going through and reading, if you will, your bio, it's like you started out, you did some stuff with some hedge funds, but then you bumped over, you went into the business world, started up a company, and it really, you actually have sat a decent amount of time in that creating a business world, like, and then now you're moved back over. What so? Besides having an exit, of a business, what moved you over here to, if you will, back here? Because, well, tell me what the business was, because I don't think it wasn't highly correlated, wasn't?
Well, the one I have to tell you, I've always loved playing with data
Yeah.
and using models. So in a sense, that business did that as well. But we
Okay.
were doing it in a different area, in the web analytics area, and the idea was to take information about how people behave and try to provide insights to companies. So people have something called web analytics running on their websites and their apps, which collects information about how people interact on your website. And the idea is to take all that data and try to provide insights. So we were building a lot of AI to do that.
Okay.
And but my first love was always finance and computers. And when I had the opportunity to say, kind of, what do I want to do with my life? Right? It's like, what do I want to work on? It was like, okay, I really want to do this AI thing, but with finance and make it available for everybody. So that was when I started AI funds. That was the motivation. Was really, can we bring that to the masses? Can we let everyone benefit from this amazing thing that's coming? Now I saw it coming, years ago, because I've been working in hedge funds and I've been playing with AI for many years. So I saw that this is something that could be done better than what's being done. Let's just say based on the leading models that most people are familiar with. So if you think about Markowitz Efficient Frontier, that's what most people believe. But that research was done back in the 1950s. Okay,
Right.
and Markowitz did amazing breakthroughs, and but we're still using the same model. So I know we can do much better than that. So bring that to the masses. Why not let other people benefit from that? So that was kind of the beginning, and that was the motivation behind what we're doing today.
Maybe this is actually a good. In one of the videos you talk about the three types of markets, right? Efficient markets, right? And um, I think that breakout of the three efficient markets, it's actually really important to understand where you're going with it and why the potential. Because a lot of people that could be watching this might look and say, well, you know, Vanguard's been founded on the very premise of passive. I mean, and nobody ever beats it, and this mantra, nobody beats the market, and so therefore we should just go into it. But when you actually look at those three types of markets in that efficient space that you're talking about, I think it opens the door to understand a little more of why you might think that the possibility of utilizing AI to manage a portfolio could have a chance at winning. Is that fair to
Yeah,
say?
yeah. No, so it's a good it's so the efficient market hypothesis was put forward by Fama, who's a Nobel laureate. And the idea was that you have this three levels of efficiency, and I won't go through all the academic words for
Right.
it, but the idea is it's either
Everybody
very
appreciates that.
efficient. What's that? I'm sorry.
I think everybody will appreciate you not going through the academic part. But so
Okay.
yeah,
So it's either very efficient, which means that no matter what you know, you can't
yeah,
do better than the market. And the idea there, even if you have inside information, you can't beat the market. And we know that's wrong because people get arrested for using inside information,
yeah,
and they
yeah.
do beat the market. So that's one extreme. The middle ground is that you could do better by using uh, uh, publicly available information. So you could do by using better way of processing the data and better insights. And lastly is that it's even with uh, sorry, I mixed them up. But the idea is you get to higher levels of the market eventually becomes you could beat the market even with public information versus private information, and there's something in the middle there. So it's semi-efficient. But the idea basically is that most academics believe that in the strong form of market efficiency, where essentially it means that you can never do better than the market. So you should just invest in passively in the market, and you that's the best you can do. And I know that's not the case. That's why hedge funds are out there. That's why you have a lot of investment firms where they tend to outperform the market, but not all of them. A lot of them underperform. Once you take into account all the fees, they tend to underperform. So the question is, can you do better consistently? That's the question. And what I've seen and what I know is that you can, but it's still it's not a guarantee. Obviously, there's no silver bullet. But if you use better technology and are able to process things in a better way, you should be able to do better than just passive investing. The word is should. It doesn't always work, and no past does not the past does not guarantee the future. But it's something that I deeply believe in this. I think that this is something that's definitely doable,
So, but the
but
question
it's
is why?
not doable by humans. I don't think humans can do it. I
Right.
think it's very difficult for humans, and the reason it's difficult for humans is because we have a lot of cognitive biases, and you can't help it, but it's built into you. It's things that have to do with the way we evolved, and we are very much a product of, we become very fearful when the market falls, and we become very greedy when the market rises. And it's probably the right algorithm is pretty much the opposite of that.
Right.
At least that's the way it seems to work. It's you become, and this is actually what Warren Buffett says: be greedy when everyone's fearful, and be careful and fearful when everyone's greedy. Right? It's the opposite. And you even
So,
had a good example of that most recently, just the last few days, this earlier this week, where the market became very fearful and it dropped very strongly on Monday. The AI we're using said no, we were still risk on. The market should go higher, And that's what I believe is probably going to happen. That where we had this bout of fear, but in general, we're still in an up market trend, and this is actually a buying opportunity. But that's my own personal conviction. That's not investment advice, okay? But that's my that's my belief.
So okay, now there's belief that the one thing I think you bring in there is, but there's got to be a little bit more to it. It is this idea that um, we as investors have our own biases that get placed into it, right? And so then the question is, look, if you're passive, you're removing that bias, theoretically speaking. Now, I don't actually, I don't think that the data supports that. I like to use the word theology, like this belief structure, right? There's too many research groups that have found that the average investor actually underperforms the market, as you probably know. And so, if the answer to the problem is use passive, because then, and you just set it and forget it, and as long as you're not touching it, well, then your own personal bias on things is not touching it. But the reality is the majority of the people get worse in the market. And so therefore, even though they're passive, they must be touching it, right? They
Yeah,
can't not touch it, right? It's like,
yeah,
oh my gosh, but it's going down, right? And we know this. I mean, are you from Israel originally?
yes, I am.
So you know this, right? You have two of the greatest minds in terms of behavioral finance came out of Israel, right?
Yeah,
And so when you start thinking and going back to what these guys were talking about, and then you start moving it forward, um, I think that's what intrigues me most about the AI space.
yeah. So yeah, I'll talk about that. So Kahneman and Tversky, the guys you're talking about, they won, they developed this theory. It's called prospect theory,
Yeah,
and turns out that it's actually true, and it has to do, and it's very different than the way economists traditionally thought about the way humans looked at risk. And it turns out that there's much more that humans there, traditional economics says, okay, this is that, okay, we have something called the utility function, which means is how we react to wealth. And historically, it's something that where you say you look at the total utility and it's convex. Okay, I won't go into all the technical stuff, but what they found, a couple of things. They found very simply that we're much more sensitive to losses than to gains, meaning the ratio is something like 3 to 1. So if you lose $100, that hurts a lot, like 3 times as much as making $100. Okay, so that's one. And it's not where you are in terms of your total wealth, it's where you are relative to where you started. Meaning, if you lose $100, that hurts. You lose another $100, okay, that's a lot worse. So it's the drawdown that really hurts the most for humans. And guess what? We're optimizing portfolios and mean variance. That's not right. We don't care about upside variance. In fact, we like that. We like going
correct,
higher. It's the
correct.
downside risk we care about, but not even downside variances. It doesn't quite capture it because that just says, overall variability in the drawdown. It's not the total cumulative drawdown. So it's the path dependence that matters here a lot. And that's a fancy word for saying that if something goes down and keeps going down, that's the stuff we hate the most. That's the
Right.
stuff that hurts us. And that's what hurts our portfolios the most, too. And unfortunately, stock returns are not just random walk the way we model them a lot of times in finance. They're actually something called serial correlation, which means when something starts going higher, it tends to go higher. When it goes lower, it tends to go lower. So we need to model and think about these things in a different way, a different paradigm that today we don't do in finance. And when we optimize portfolios, that's the way we need to look at them as well, is trying to reduce those drawdowns and optimize for that rather
Is
than
it,
just variance.
so if I was to kind of, and I don't know if I'm jumping all the way to that point, my contention for so long, this is something I argue in my industry on a regular basis, is that we do a terrible job of our job. And look, I sat with clients today and we talked about their lives and goal setting, all these great things. We didn't even talk about the portfolio at all. But what is my real job? My real job is to help them gather their assets in whatever form, right? and to let those assets grow. But in what we're talking about, the majority of my peers only think of the growth in terms of it sitting inside of something, the Qs, SPY, a mutual fund, annuities, right? They only think of the growth in those terms. Whereas I think the bridge that we're moving towards is that growth happens both inside of that space, but with the individuals not touching it at those moments that you're talking about, where the markets actually are correcting, or not being involved in something that's correcting as much, so their anxiety and everything else isn't there. And that two-part piece to me is pivotal in terms of what we do in as far as advisors, because it should be managing not just the expectation, but it should also be managing the behavior of the individual, so that they're comfortable as something as the market's moving down, they don't see theirs moving down, which is part of the reason I started working with you.
Yeah. So I think that's exactly right. I mean, really the paradigm today that most people work with is saying, here's the mix of assets you should own, and it's static. That's it. That's what you should own. And for the next 10 years, maybe as you get older, you might change it, make it more conservative as they get closer to retirement. But that's the paradigm, and that's it. And it's kind of like you're saying, is that the best we can really do?
Right.
And when you think back to our beginning of our conversation about how AI is doing so much better at playing these games, well, guess what? When you let AI play the game of investing, it figures out that sometimes it's better to reduce risk and not take so much risk. And sometimes you want to take more risk. So it's kind of like the game that, if you think back to also the quote that Buffett said, it's kind of like playing the game where, okay, I'm going to load up when some people are, where people are getting a little fearful, and sometimes I'm going to take less risk, and sometimes people are right to be fearful because things are about to go down much more. So being able to tell when to take more risk and when to take less risk, that's something that AI can do better than us. Okay, because of
Right.
our emotional, because of all these biases that we have, that we know we have, we are very bad at that. But AI can do a better job. So AI can do the AI we built can do two things. One is figure out how to go and raise or lower risk exposure. And the second thing is how to build a portfolio that's better than just, Markowitz mean variance optimization. Okay. How can we build a portfolio that when is risk on, it actually goes higher more than the market. And when it's risk off or higher risk, how can it drop less than the market? So you want to win in both regimes. You want to win both when the market's going higher and also when the market's lower, going lower. And that's what we try to do and what we've been able to do in the last few years. But it's, as again, no past performance is no guarantee for the future, but that is the idea behind the model that we've built, is really trying to do that kind of interplay and essentially try to have it learn how to play the game of investing in a smarter way than just the way we've been playing it historically. Because you have to
So
remember, historically, those models were built on the old models of economics, where, okay, we just have this one utility function, and there's no, the fact that, you go down 100 today doesn't have nothing to say about tomorrow. And we know it does have something to say based on other things that are happening in the market.
so how much, kind of to loop the two back together though, when you're working with your model and you're building in your model, um, the the model itself could work from a perspective of maximization. Now, maximization could have a lot of drawdown inside of it, or it might not, right?
It
And
depends what you're
so,
maximizing. It's really important what you're maximizing.
yes,
What is the function? What is the thing you're trying to get the best of? Right?
right,
Makes a big difference.
yes,
So, so you might be wondering, what do we maximize? So it depends on what the customer is looking for. So we have some models where the idea is, I want to invest in the market, but I just want to avoid the drawdowns. Can you just avoid that? So
right,
whenever there's a drawdown, just take me out, and I'll be like in cash like ETFs. And when the market's going is likely to go higher, I want to be in the market. So we have models, we have those type of investment strategies, and those basically it's kind of like saying, you know what, I want to invest in the S&P 500, but whenever it's going to have a drawdown, just take me out of it. So that's one set of strategies. But you have to understand this again is statistical, so it catches some of those drawdowns, not all of them. Okay,
Right.
so it doesn't. It's not 100% right, but even if it's 50% right, it's a huge value in terms of that, like the delta to whatever the market's doing. At least that's what we've been seeing. The other set of strategies, and this is more common for most investors, is maximize return per unit risk. And that's if you've heard the term Sharpe ratio, that's the old way of what we thought about maximizing. It's the return divided by the standard deviation. And then we've had the next term after that is Sortino ratio, return divided by downside deviation. And there's many other of these terms. So RAI is trying to do a maximization of return per unit risk, where return is something that it estimates what the potential return is for different assets in your portfolio. Typically, these are ETFs. Okay. So, what is the potential return? And the denominator is what is risk? Well, risk is a combination of different things that are risk for investors, drawdown, downside risk, different things that are risk for humans, not the academic risk, not the standard deviation, because remember, we like that upside deviation. We
Right.
like going higher. So we don't want to have that in there. But the downside, different measures of downside risk and some very smart way of looking at them together, that's what you're trying to optimize. And you get the AI to think about that. Okay, now that we know that this is what we're trying to do, how do we go about maximizing that from a portfolio and you have a universe of ETFs that you're going to pick from? How do you do that? Okay. And then lastly, you have the last type of maximization, which says, you know what, just maximize risk. That's super risky, by the way. Because when you tell AI just maximize risk, it's gonna be like, okay, how can I maximize return.
Oh yeah.
Maximize return regardless of risk. Sorry, not
Right.
maximizing risk. Maximize return. But then risk can blow up and
Right.
it could be very volatile. So that's like trying to tell it, just hit home runs all the time. Well, guess what? It's not gonna hit home runs all the time. Once in a while it hits a gutter ball, but it's in the long run it's going to do very well. It's just you're going to have a lot of fluctuations there. So those are the kind of different levels of risk. The way I tell people to think about is, if you're trying to think for the long run, I would recommend mostly maximizing return per unit risk, because that's what humans can usually stomach.
Yes.
And that's the way you should think about that. If you're just trying to maximize return, you're not going to be in the strategy for a long time, or that strategy needs to be a small percentage of your portfolio because it's just going to be very volatile. So you should be aware of that. So for most
So
humans,
if that latter one though, I wouldn't think that the latter one means okay. I'm going to maximize risk. I'm just going to go into oh gosh, Kathy, what's her name's, all tech,
yeah,
ETF.
yeah, yeah, Kathy Woods ETFs, the
Yeah,
ARK
yeah,
ETFs,
yeah,
yeah.
yeah. Yeah, so it's got to have a little bit more play in there, right? Because it's got to be still thinking like, well, if I'm going to maximize or not risk, but maximize return, it still has to understand that maximizing return is still a function of minimizing drawdown at the same time.
Yeah, yeah. So that one, it's something we are improving,
Yeah,
and it's improving on its own. It's figuring it out. Thing is, it's not a static model, right? It's learning all the time.
yeah,
So that's an important aspect of it. So it's learning that just maximizing return doesn't always work, because then you have drawdowns and that doesn't work in your favor. So you still need to reduce risk to some level, but it
yes,
takes more risk than our other models. So it's still, the volatility is still above 100% of the, if you think 100% is the S&P 500, so it's still
yeah.
above 100%,
Interesting.
but not crazy. It's not 300%. Okay, it's less than that. So it's basically figuring out where do I need to be on that risk return profile to be able to maximize return. I still have sensitivity to risk because I want in the long run to do really well,
Yeah.
right? So it's still in there,
What's
but
the
not
standard
quite as
deviation?
explicitly.
Is the standard deviation higher than the S&P on that one? Just out of curiosity.
Yeah, it is.
Yeah.
It is. It is higher. It is higher. Yeah, not a lot higher, but it is higher, and all our other strategies are below the standard deviation of the S&P, because for most people, they wouldn't want to have 100% of their money in the S&P 500. That's just a lot of volatility for most people. Most people are somewhere, at least from what we've seen, people are between 50 and maybe 80 or 90% the volatility of the S&P. That's where most people are
So
comfortable
is when you
having their
say
wealth.
when you say you see that, let's go back to that behavioral conversation, right? So
Yeah.
is some of that looking at the behavioral side and saying, look, if I use the bell curve, right, and I said, look, I want to get 80% of the people not to touch their money, right, and that sits somewhere with a 10% or a 15% decline in a 3 month or a 4 month period. I would assume you like there's some math metrics that you've already played with in there, like, okay, that's about where we want to sit in terms of our drawdown.
Yeah, and you know what? This what when you model this and you look back, the future doesn't look like the back ever, right? The past. So
Right.
you always assume that things could get worse than what you've seen in the past, right? So you always want to kind of move a little bit lower in terms of your risk exposure, what you're putting people in, because that's our our duty as managing wealth. So it seems like most people are comfortable, and when I say most people, I'm talking about, let's say, the 80%, somewhere in the 60-70% volatility, 50 to 70% of volatility of the S&P 500. That's probably where most people are comfortable. They're willing to accept that in their portfolio. And at the same time, if you can give them return that's higher than 50 to 70% that of the S&P, they're very happy with that. Because on
Right.
the one hand, you have less volatility. On the other hand, you're getting more than you'd expect, right? If you're at 50% of volatility, you'd expect to get half the return. But the reality is, with the right modeling, and this is what we try to do, is you could get better, much better than that. So that's the idea behind what we're doing here. Is let's get less volatility, less the beta is lower than the S&P, much lower, and you're still getting a higher return. So the in finance term, you get a positive alpha. So you're doing better than you should just if you were running, a regression versus the S&P or more sophisticated, multi-factor models. So again, I'm getting too technical, but the idea is that can you do better than what than just passive investing? And that's really the idea. Is can you do better than that by actively doing managing the money, but not by a human, by an AI
So
that's figuring out all the time where the market is and what the risks are and how can we navigate it in a smarter way. The analogy I
so
like to, yeah, so there's a
I was
lot
going
of
to say,
analogies you can give here, but
I would say that if I was to put it in there, it's almost twofold with what you're saying, right? Can you do better? Well, you can do better fairly easily by managing the behavior of the person that has the money invested, right? I think if you can manage that behavior better, so that they don't touch it, the data supports that they'll do much better, right? There's plenty of data that research has gone there and said it.
yeah.
So that part, okay. So you can work in that part with AI, and first, okay, that's the first kind of metric, is that risk. How do we contain some of that? We already know where people jump off the ship at, right? And they're like, okay, I can't. So there's you can manage that, but then the next thing becomes, it's not just the downside, it's also how do we move back in, right, and make sure that we're getting enough return to satiate the appetite of the investor, right?
Exactly, because there's it's almost like you want to give them the return, enough return so that they feel comfortable with it, with the model. On the other hand, you don't want to give them the risk. That's really where we're trying to get, right? And the risk is really the drawdowns.
Yes.
That's the risk. So that's what our AI, which we call Bela, which stands for Bayesian AI learning algorithm. That's what Bela is trying to do. It's trying to figure out, can I get a higher return while reducing the drawdowns that are really what's fear for most people, and that's where they bail. I think that if we can get that, that makes the job of the advisor that much easier, because it's
Yes.
much because the people are not going to want to bail out if they're out of the market when it's correcting, and they're in there when it's going higher, and not always, but most of the time, and at the same time they're able to get enough return to satisfy their portfolio goals and their retirement goals and things of that nature, then they're going to be happy, and it's a win-win for everybody.
Right.
So that's really what we're trying to do here.
So maybe that's probably perfect time to kind of talk about beta. It's like how, so you've looked at the different things, and then you go, okay, here's if you will, here's my Claude. Like here's my way of getting in and going, okay, but you're going to do this in a narrow channel. So you've gone through, you've built some underlying algorithms, I would assume, and but then you've also got this massive data pool that it must be searching from. Like, give me some color on all that.
Yeah. So I mean, so we built Bela basically looking at the way humans run investment houses. And if you think about the way a human would run an investment house, they would have two roles in general there. One is a macro strategist, and the other is a portfolio manager. Okay. So those are the two roles that Bela is trying to play. What does a macro strategist do? It basically looks at a lot of different macro variables, including what's happening in the market itself, and it tries to kind of draw and create a picture of what this is like when you compare it to history. That's what they do usually. They kind of say stuff like, "Look at inflation. Look how it's risen, and look at the oil prices, and look at the market. What doesn't this look like 1975? And back in 1975, this is what the market did." And they try to make this comparison and kind of make a prediction about the future based on that. But they usually only do it for one point in time, maybe two. We kind of took that same idea and we said, you know what, let's do it on the last 50 years and not just use a few metrics, just use a bunch of different metrics. And in effect, what we're doing is we're saying think of it like an economic fingerprint. This is what the economy and the market looks like right now. This is what it looks like. This is the picture. This is the pattern. Go back and find all the last times when the pattern was similar to today. There's never been a time quite like today. It's very unique, but there's similar times. History rhymes. It doesn't repeat, but it rhymes. So there's all these other times that are similar. And look and figure out computationally what happened in the future. And if you look at that, what you end up is all these different paths. And then you can figure out, okay, there's something called the distribution of returns. So it's like saying, what is the future likely to do? There's no sure things because, you had all these points in the past. Sometimes the market went up, sometimes it went down. But give me a distribution. And then Bela studied that distribution and tell me, what is the market likely to do right now in the future? Is that something is that probability distribution likely more skewed up, meaning, or to the right, meaning it's more likely to the market will go higher, or is it more skewed to the left, meaning there's more likelihood the market will go lower? And then based on that, can you give me some probability of that and those events happening? And can we make a decision based on that that will allow us to optimize the portfolio in a smarter way? So the macro strategist basically is saying is the market more likely to go higher given where everything is playing out right now? Or are we in the danger of the market going lower? That's what it's trying to figure out. So Bela is all the time playing these probabilities and kind of like, if you're playing in a casino, the analogy is basically playing in a casino. I've been counting the cards. What's the probability of the next card being? Is it likely that it's a bull market card and the market's going to go higher? Or is it a bear market card and the market's going to go lower? That's what Bela is trying to figure out. It's trying to count all the cards, look at all the patterns, go back through history, and do it in the most scientifically robust way possible to figure out the probabilities that the market's going to go higher or lower. What traditional finance will tell you is that's impossible to do. They'll tell you you can't do that. The market, it's random walk. Who can do that, right? I don't agree with that. I think AI can actually do that. It can actually figure out, and that's what AI is much better than humans at, is figuring out all these patterns and looking back and figuring out what's going to happen. So that's the macro strategist part. Does that make sense?
Yeah, I mean, on the macro strategies, it's almost I'm kind of thinking of like a I don't know if it's not an infinite, but a hundred or a thousand different Fed fund guys, right? Where they all have their own idea and their own little things that they're looking at in terms of, is the market running hot? Is the economy overheated, right? And then they all get together and then they decide, right? But instead of just having like whatever there's 12 or whatever it is guys that are doing this, you have 1,000 guys in there, but they're in there now. They're asking the question in a multiple ways, and then they're testing, if you will, their theory, back testing it, and seeing which guy in that grouping becomes right. It kind of to put a man in the computer, if you will.
You're kind of it's actually funny. There's a bunch of machine learning algorithms that work exactly like that, where essentially it's a bunch of these little voting guys, and they vote together about what their opinion is, and then if the majority vote in one direction, you say that's the right vote.
Right.
So it's always that's not exactly what we do, but it's we've tried all those algorithms, tried a whole lot of them. We built our own, but the idea is it's very similar to that. It's kind of like saying let's all each one of them has its own thing that it's looking at, and it's making a decision, and then you take all of them together and you figure out, well, it turns out when you look at all of them in aggregate, you get better decisions, you get better votes.
Right.
And it's kind of like taking all of them together. But if you're absolutely right, the Fed has, I don't know how many people on the committee on the FOMC, they get to vote, but it's a few people, and it's based on their experience and the data that they're looking at. Now imagine if, just like you said, you 1,000, 1,000,000 of them voting, and they're looking in many much more data and much more detailed, looking at the whole history. They you would think could get a better job than the Fed, right? And the Fed right now, is making a certain decision about when to ease interest rates. And you kind of think, and in a sense, the model is trying to predict, well, what is the Fed going to do now? And is the Fed what the Fed is doing? How is that going to impact what's going to happen in the
Yeah.
market and what's going to happen in the economy? Is the Fed too late, or are they on time? Are we going to get a soft landing, or is it going to be a hard landing? What is the implications for all these things moving forward, and how much of that has the market already incorporated into prices?
Yeah.
So there's a lot of moving parts here. It's actually really this is what makes the problem so difficult. It's not a clearly it's not an easy problem to solve, and there's a lot of randomness here because you can have surprises. Like we had this jobs report on Friday, and everybody was like, "What? That wasn't something we were expecting." And
Right.
all of a sudden, the market reacts, and the narrative changes. So you can kind of it's all the time learning and figuring out what's going on, and because there's all these surprises, it's kind of random too. There's a lot of randomness in there too,
I would.
so
I would.
it's a really hard problem.
I would think though one of the things that gives it a little bit of an upper hand is if you took the same analogy with these all these Fed guys, right? But then what you said is, look, what we're going to do is each one of you has been looking at one set of data that's wrong. It's actually you think it's right, but it's completely wrong and it hasn't helped. And here I can show you, the probability of you using this. It's gonna change nothing, or it actually is going to interfere with your decision making, right? And so where AI can sit in there and then go, is this piece of data important or not important? I mean, is that play into there at all?
Yeah, it does actually, big time, because the data that's important changes over time. Interest rates are really important right now because Fed funds rate is about 5%. It wasn't important at all 3 years ago. Your Fed funds was near zero, so
Right.
that wasn't even like a factor. Interest rates were not really that important. They were important, but not like they are today. Interest rates now are driving and big time driving what's happening in the market. So whatever is driving the market, it changes over time, and that's why the models, like static models, don't work very well. They have to be adaptive and changing over time because the market reacts to different things over time. So it's something that has to adapt and change. And that's why, our traditional statistical models, where you think about like a regression, you have these factors. Uh, those factors change. And if they've changed, then the model changes all the time. So
Yeah.
that makes this really, really difficult to do. I also, one more thing I should add to your analogy, the way you model the Fed, you can't model them the way like a perfect optimal decision maker. They're human. And that's a problem because it's a problem, it's also good, but they're looking back at history and they're remembering, Paul Volcker in the 1970s. They remember what happened when interest rates were cut too soon and inflation came back. And the last thing they want to do is make that mistake again. Okay.
Right.
Because they're
Right.
supposed to learn from that. So that ends up pushing the time that we actually start cutting rates later, just because they want to be sure that inflation is really defeated. But guess what? If they wait too long, they might actually drive us into recession. And that's happened before too. So it's really the fact that they don't want to be wrong. And by the way, they were wrong because they waited too long to raise interest rates where they kept saying inflation was transient. So they've
Right.
been already wrong. They know the history of being wrong. That they don't want to be wrong again, but guess what? By trying not to be wrong, they'll be wrong. So it's
Right.
almost
Right.
like because they're trying to they're trying to play this game against themselves, and they know that everybody's watching them, so it makes it really difficult. But the worst thing that could happen is they lower rates and inflation comes back, and then they have to go back and raise
Right.
rates again. So they're trying to play this game where they're trying to make sure inflation hasn't doesn't rear its ugly head again, but at the same time they don't want to push the economy into a recession. So how can they glide us into a soft land? It's really difficult for them because they're playing with their own cognitive biases. So that makes it difficult for them. And AI could do a better job than they can. I can tell you that based on my models, inflation is, it's going down. It's going to go down faster than they're expecting it. And they're probably not lowering rates fast enough. So they can play it looser, but they're not, because again, they don't want to make because
They,
of their
they
own biases.
they haven't called up the doctor. That's the problem. So they,
We all suffer from the same biases. That's the thing. It's amazing. Even if you know that you have the biases, you still play the game the same way.
yeah. So you've got so with Bela, there the set there's still got to be a set of data, right? There's a because you're in a narrow model, so in that model you're pointing to a given set or given. It's like pointing to a lake and saying, okay, in there is the fish, right? Now I'm not sure what fish you're gonna go try to catch today, but that's where the fish are at. Um, Maybe give us a little more color on that, like how does that model get set? Where does the information come in from? What's the pipe, if you will, that's feeding Bela to make these different decisions?
Okay, so it's a good question. So there's a lot of different types of you can think of it as different types of data that comes in. We think of them as time series. So we call it time series because it's basically data that changes over time, and we have it for a long time going back. And the idea is you can look at it at different resolutions. You can say, well, what happened in the last day, the last week, the last month, the last few months, the last year, and you see patterns in there. And then you tell Bela, well, okay, you see the patterns. Go back through time and find out when those patterns seemed very similar to what we're looking at now. And I think that that's the first part, and it does it on a lot of different set of variables, right? Trying to figure out when those patterns repeat. And in aggregate, it can kind of say across all these different variables and the variables that are important today, what are the most similar times in the past? Okay. So give me the top, X% of times that are similar to today. And you can say, in the last, 50 years, we've had, here are the last, yeah, I'll just make up a number of 1% of all the times that are similar to today. So when did those happen? What dates? And it kind of goes through and figures out in a very, you can call it almost, it's a computerized way. It kind of says, what is the likelihood? What happened back then? Did the market go up or down? And add all of those together to figure out what's going to happen in the future. So in a sense, it's doing this mechanical thing to figure out similarities to the present. That's why I talked about a fingerprint, because it's kind of like saying, well, what is the similar times to the present? It's not doing a thing where you're saying, wait, is it looking at interest rates? It's looking at a bunch of different things, lots of them, dozens of different factors. Um, but it's kind of saying, what is kind of like, where are we now? And what is the current picture? And it's then trying to learn from those factors, the patterns, and what does that mean for the future, and what did it mean in the past. So in other words, it's trying to say, if I was figuring out all these patterns recently, would I have gotten right? Would I have been able to match things recently? If I looked in the last week, the last month, would I have made the right call if I was looking at this factor or that factor? What was really important in the model? And it's doing this kind of process of learning that's really hard for humans to do, because just the amount of data is enormous. So
Yeah.
um, where we the way we learn by making up narratives. Okay, we kind of say, oh look, it looks like there's a rotation now between this and that. I don't know, large, recently people had this narrative. There's a rotation between the Magnificent Seven and small cap.
Right.
3 weeks ago, that was the narrative, and now it's kind of changed again. And it's like, oh, people were all into AI. Not they're not so much into AI stocks, but guess what? That's going to change again. So, people that's the way people think about the way the market works, and it's one way to think about it. The other way to think about it is mathematical, and to say there's all these relationships and all these patterns that we can explain by saying a narrative, and but it's really the underlying mathematical relationship that's really driving things around. And can we build a model that figures out all those relationships and then tells us how, what's where the market's going? If it's going higher, what assets are going to be moving higher with that and what are not going to move as much? So it's almost like, where are things going and what are the set of assets that are going to be related to that? So it's almost, think of it as a mathematical construct. It's almost like, the analogies, you can think of it as a neural net also, but it's not exactly that, where there's a relationship between all these different assets and they have all these weights, and it's almost like a space. And when one thing moves, something is following it, and other things move in the other direction. And so it's a very
So it's,
um,
if you will, I think
dynamic space of.
you're digging into two different components of your AI, if I remember and understand, because you have the one component that looks at risk, and is saying, hey, should we be in risk or out of risk? And then you have the second component that says, okay, if I'm in risk, what risk should I be in? Right? Like what location, where should I place these assets?
Yeah.
It's separated like that. Is that right?
Yeah, it is separated like that because each one of them does a better job by figuring that part on its own. So you can figure out where to be in the market by doing a very clever portfolio optimization. And you can figure out what's going on with the risk by doing a different kind of model that I can't talk exactly how it works, but I'm giving you kind of like the intuition of how it works,
Right.
where it's essentially trying to kind of like figure out the patterns that are going on in the market, and then sensing like what is the likelihood of the market dropping. So in a sense, it's what it's trying to do. Really, what it's really trying to do at the end of the day is tell me when the probability is high enough that the market will drop above more than 5%. I want to step out of that. Okay, when the market's going to drop a lot and the probability of that happening goes high enough, that's when I want to take my foot off the pedal. That's what it's trying to figure out. Turns out that's I mean, obviously it's hard to do, but it's not trying to tell you the market is about to go crazy high. No, the market, most of the time you should be in the market. That's over 80% of the time the market goes higher. You need to be in the market most of the time. Can we detect when the market is likely to actually drop once in a while? Can we get that right? Doesn't always get it right, but can we get enough of those times right that it makes sense to step out of the market?
Right.
And that's what it's trying to basically do. And it does that by figuring out all these different patterns that tend to repeat themselves before the market drops. Okay. It has something to do with volatility. It has something to do with interest rates. It has something to do with the market, the way it moves. These things, that the patterns that are there, and other things that are happening, all these other factors that are kind of moving in a certain way, that kind of risk that tells you, oh, hey, the market might be about to fall. I mean, sometimes it has to do with oil prices, moving up high and creating a certain pattern that you're like, okay, we've seen this before. The market does this, and that, and it can fall. Okay, but do we see it in the other factors as well? Does interest rates moving? Is the market doing some kind of weird bouncy thingy that, okay, together with oil prices, okay, now it's risky. Okay. I don't know those things even myself. It's really complicated, but the AI is able to figure it out and says, oh, listen, this is starting to look kind of scary. We should probably take the foot off the table.
In that
So that's
in that space, what about geopolitical stuff? So is it looking at news or heated up areas, or like how does it play into that?
So it turns out that all that news, it doesn't listen to the news and try to, at least not yet. We haven't plugged it into like an LLM, which can actually interpret the news and then do a feedback into the algo. Although that's the direction we're going to go into because it makes a lot of sense. What we find is that a lot of the news gets impacted into asset prices fairly quickly. Most of the time, the macro news gets impacted fairly quickly. It's rare where it takes a while for that to happen, but usually you see the jump in prices fairly quickly. When something happens in the Middle East, oil prices react very quickly. There's very little delay there. So you can see the patterns in the actual prices. It's that when you take all of them in aggregate, is when that has an implication for the stock market that's not necessarily there.
Right.
All of them together say something that for us humans is hard to see, but the AI can see it. And when we try to do it, we end up with a lot of false positives, which means that we end up thinking the market's about to fall. Oh gosh, we need to get out. And that's when you miss it. So you want the AI to do it because you only want it to pull you out when that probability is really high. And you can't, and for us humans, it's hard to tell when that probability is high. And we get scared very quickly. So, and guess what? That's one of our biases, right? So that's when you talked about a lot of investors pulling out of the market too soon. That's what they do. They end up pulling out of the market too soon and missing up the opportunity, which is in the long run, you need to be in the market.
Right.
So that's kind of that's why passive investing has done well, is because it's in the market all the time. You're just passive and that's what you do. But if you could theoretically pull out in the right moments, only when it's really risky, you would do even better. And that's what Bela is trying to do with the macro strategist part of it.
Yeah, I mean, I think it's interesting. We know that like this year, it did well in April, right? It pulled out at the right time, and I mean, it really hit a home run in April, right? It pulled out, and sometimes what's the word? It's better to be lucky than good because Monday happened to be because it only goes in on it goes
And
in once a
Mondays,
week, right? Yeah.
yeah,
And so Monday happened to be the high and the low. It wasn't like a Tuesday or Wednesday, right? Like it just worked out well in that space.
yeah, no, it worked. I couldn't have asked for it to work better. And again, it's some of it is luck and some of it is the algorithm, but it went it went risk off, I think, on a Monday on April 1st, and then went risk on Monday, April 22nd. So it almost hit the high and then went back in on the low.
Yeah.
You can't ask for anything better than that. So it gave you like a nice 5% delta in the S&P,
Yeah.
over 7% delta in the triple Qs.
Yeah.
That happened to work really well. But you look at this past scare we had, just the last couple of weeks, it's risk on. It hasn't
Yeah.
pulled out, so it missed that drawdown. Now, if it hit that one, that would have been amazing. But that again shows you that it doesn't always work. It doesn't
Right.
always catch it. And I think what we had just even this past Monday was something that's very hard for the AI to figure out because we had the surprise job report, and the AI did not, obviously that surprised everybody. Oh, and even more than that was the Bank of Japan raising interest rates by 0.25, which completely freaked out the Japanese market, ended up creating this carry trade unwind, which ended up selling across the global markets and ended up pulling our markets down too. So you had this cascade effect, and of course, humans being very fearful. There are people who made a lot of money in the last couple of years started selling too. So you had this cascade effect and this crescendo of fear, and the VIX went over 60. The AI did not change its posture. It's been risk on. It's actually telling us this is a good time to buy. So it's
Right.
like, you know, so it's risk on. It's been risk on throughout this process. So either it's completely wrong and we're at the beginning of a huge correction, which I don't think is the case, or this is one of those bumps that it missed. And
Yeah.
it's been hard to it's if you look at the way this has been played out, it's been very sharp drops with the market being fairly flat in between. So it's been hard to kind of like, even if it was trying to get in and out, it would have been like very, very hard to try to time it perfectly if you're looking on a weekly basis. And it's trying to do it on a weekly basis, by the way. It's not trying to do it on a daily thing. It's doing it
Right.
on a weekly, saying on a Monday, you can trade on Monday and you can only trade on Mondays. Is this the right time to go in and out on that Monday? So it's not, it just didn't, the specific correction didn't work out with, especially with the timing that we're
Yeah,
doing.
interesting. Well, I don't. I think I've hit most of the questions that I wanted to hit in there. Obviously, it's fascinating. Where do I mean? I guess maybe the summit. Where, like a year out, 2 years out, where do you see? Maybe just start. Where do you see AI? Where are you
Yeah.
fearful in that space? And then where do you see AI funds?
Yeah, so I'll start with the high level things. There's a bunch of trends going on in the AI world. I'm very much on top of it, so I can kind of give you the high level. I would say there's three major trends happening right now. One trend that we all aware of is these models are getting bigger and bigger, smarter and smarter. So that will continue. And when I talk about the model, these are the frontier models like the ChatGPT, the Claude, the Llamas of the world. So these are the big companies playing in the space are OpenAI, Anthropic, Google. These are and Meta. So these are the big companies playing in the space. So those models are going to keep getting more and more compute, and they're going to get smarter and smarter. Okay, but at the same time, there's another trend where you're getting models getting smaller and smaller. So you get models that are getting small enough so they can fit in your smartphone and on your laptop. So we're going to get models that most of the time you're going to work with them on your smartphone and they're going to do 80, 90% of what you need on your phone, okay, and on your laptop. And once in a while, you go to those cloud models, which are more expensive and bigger, and are the frontier to answer more sophisticated questions. So the paradigm is probably going to split into two, where you have local models and the edge devices, the small ones, and then you have the larger models on the frontier models that you call on the internet. Okay, and you probably pay for those as well. So that's I would say a trend that we're seeing right now. At the same time, the narrow area of research is going to continue, and you're going to see more and more areas where you have these very advanced models that solve specific problems really, really well, like AlphaGo, like Bela, and Bela gets smarter and smarter all the time, and so does all these other models. So we're going to see those in our lives. So you're going to have a situation where you're going to have a lawyer that's a legal assistant that you can use that use maybe 80 or 90% of your time to get legal advice from. That's going to know the law really, really well, and then you'll still use a human lawyer. Same thing with a doctor. Same thing with an accountant. Same thing with a lot of these roles are going to become available to you with very narrow knowledge, very deep narrow knowledge that are going to be able to answer a lot of the questions, or 80%, 90% of the questions that we have, and are going to be as good as the best doctors. You'll still want to use a doctor, a real doctor, trust me, to prescribe medicine and do all those other things that you need a doctor for. But you'll be able to get a lot of the value from a local model. So those are the things that are going to happen. And those narrow models, they're going to be small. They're going to be able to fit on your, laptop and phone. So we'll be able to have, a mobile version of a lot of the experts that we use in our lives. And whatever expert you have in your life, they're going to use those models too, and they're going to become better as well. Okay, so your doctor is going to be much better because they have access to all the medical knowledge that's being synthesized in real time based on whatever you're telling them. So and they'll be able to say, like, you know what, there's a very rare condition that we need to verify you don't have, that he may have read when he was in medical school about, but he probably forgot because he hasn't seen it in 30 years. But it might be something that you need to check, but it's not something that would be classical thing that would be at the top list. But the AI will be able to flag that based on whatever symptoms you have. And AI is already being used for narrow models, for example, to detect cancer and CAT scans and other abnormalities. So there's many narrow areas where you're going to see AI take over or help a lot. We're seeing it in developing, in programming and things like that. So that's going to accelerate. You're going to have the large model, which are general, which are going to become smarter and smarter, and eventually they're going to be like, you're going to converse with an AI the way we saw in sci-fi and Star Trek. You're going to talk to your computer, and that's going to happen in like this year. So that's something that OpenAI launched, and I think that's going to become the main mode of communication with an AI. So you have all these trends, and what that means in general is that AI is going to become more and more of a bigger part in our lives. It's going to make us more efficient, the way the internet did, the way personal computers did. It's going to be the next big thing. And it's a wave that we're just at the beginning. And it's a wave that's going to last for quite a few years. If you think about computers, okay, that was a wave that took 20, 30 years. The internet took 20, 30 years. This AI thing, it's going to take a while, especially the embedding of it in everything we do in our day-to-day lives. So it's something that's going to be with us, and it's going to be, in terms of, when you look at the evolution of life, of human life here on Earth, it's going to improve our quality of life tremendously. The way electricity did, the way all these things, very fundamental inventions. Because if you think about machines and what did machines do, they took our brawn, our muscle, and basically amplified it many times. What AI does, it takes our brains and amplifies it many times. So that's something we haven't been able to do so far. So think about all the problems, all the things we try to do. It's going to make us like smarter, okay, in many ways. So that's the way I think of it. And that's why I know that the future of investing is AI, because it's going to make, however good the best asset manager out there, portfolio manager, I don't care who you are and how good you are, AI will eventually be better than you, because it could see so much more. It can see so much data. It could build portfolios in a smarter way. So that's in my opinion, the future of investing is going to be AI, and that's where we're headed. So that's what we're doing with AI funds, and that's why I want to bring it to the masses. But I think it's also going to be to everyone. Really, I want everyone to have access to this. But I think it's not just going to be us. It's other companies out there are going to figure it out and try to do this as well.
I think there's probably a point of clarification in there, right? When you're talking about that model, there's so let's bring private equity into it, right? Um, the idea that private equity, that an AI model is now going to usurp a private equity, even in the next 5 or 10 or 20 years. It would seem more likely to me that private equity will utilize AI to, figure out, okay, what businesses do I want to buy, and what's the best way of optimizing it, and how am I going to brand it, all that stuff. They're going to utilize it. But the idea of an AI, if you will, running private equity fund, like, that just seems a little like there's got to be some other things in there.
No, 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 no. You're absolutely right. So here's the thing. As I said, the narrow models are going to be, superhuman level, like better than any
Yeah,
human. The broad models, those are the general models. Those have a long way to go, because remember, we're at level one, maybe getting to level two. There's 5 levels. Okay,
yeah,
we're not close to 4 or 5 with those general models. That's going to take many years of R&D and work, and a lot more investment in infrastructure to get there, and many
yeah,
more innovations, by the way, beyond what we have now in the way those things are built. Because, as I mentioned at the beginning, our minds are much more efficient. So we have to get the efficiency up in terms of how you learn and how you do things, to be able to get to a level where we get to level 4 and 5, in my opinion, in the AI, in the general AI. And the way private equity works, that's a general AI, because you have to synthesize a lot of information to be able to get those ideas of what to put together and how to market and how to do that's a lot of work. They'll use narrow models and maybe some of the the chat GPTs to help, I don't know, write some of the ideas, but it's we're not there yet for that. The narrow models they could use, if you have a developer, they're using AI to help them program today, and that's making them two,
right.
four, 8x more efficient. Doctors are going to be more efficient by using this narrow AI. They're already using it today to read the CAT scans. They're using it to highlight what they think, where they think, and then a human person is looking at the AI results and saying, "Oh yeah, it's right. This, and that. Maybe this one they missed." So you still need the human in the loop today, but it's happening already. So AI is helping us get better already. That's in real time. And some problems it could do, very narrow problems like playing a game or building a portfolio, it could do better than humans. So I think there's some areas where the AI is better than us, and we'd rather have them do it. In other areas, for example, being a financial advisor, I don't think an AI is going to replace that for a long time, a long, long time. But maybe not in our lifetime. Okay, probably
Right.
not in our lifetime. Why? Because humans need a human contact. They want to talk to another person about their portfolio, about their needs and wants, their dreams, and what they're scared of, and all those things. They need to do that with a human. and an AI is not going to be able to do that for you for a while, at least a long time. And they want to have a human contact, but when they look at the results of what's doing best in the market, they'll realize, you know what, the AI is beating my passive portfolio. I'd rather have the AI run my business, run my portfolio. That's the area where I think humans are going to be much more comfortable having an AI do it.
But I
So
think that
I think that's level of comfort is going to grow over time.
so. I think that's where I'm trying to get a little clarification because when you say AI running the portfolio, I think based upon our conversation, really, AI, the best place it's sitting today is in the equity space, the broad equity space, right? And so um, it would seem like for us, we use alternate assets, right?
Okay.
And so because we use that alternate assets, the idea that it's there we're exchanging our type of risk in that alt space, right? And so it's actually not a fair game if I said, okay, AI come at me here because AI is I'm taking different I'm making that exchange as you know in that space, right? So
Yeah.
is it would it be cleaner to say in your absolutely in your equity sleeve, it makes a crap ton of sense for AI to be managing that equity sleeve, and
I
probably
think what
later
you
on in bonds as well.
Yeah, I think if the asset has a time series, meaning you can track it and you can give it an AI to process it, it would do a very good job. It
Yes.
would do a very, very good job. If you don't have that, like in private equity and other areas where it's like, okay, you can't observe that, so it's much more difficult.
Yeah.
I think it's going to take a long time before AI gets there because it has to process other data to be able to do it. And it's going to take a while in that area. It will do it eventually, I think, but not now. Now you need to have the time series. You need to basically get that. It's whatever comes in on a ticker feed. You could probably train an AI to learn how to read that and how to optimize, how to own that in a portfolio.
Right.
So I think it could do it. It can do it. It does it in equities. It could do it in bonds and probably other things, but that are that are on the ticker. But if it's not on the ticker, it's going to be harder. Eventually, yes, I know there's an AI out there that's trying to do it in real estate. They're trying to take the data and on Zillow and other factors and figure out like where you should be investing in real estate and all that. It has a so-so success rate from what I understand, but I haven't played with it myself, so I don't know for sure. But I know some people are trying to apply those in some areas. It's much easier when you have a lot of data. Just like we do with ChatGPT, you need a lot of data to train the AI. We have the same problem with financial data. You need to have enough data so that you can train it and so they can learn the patterns. And in financial data, unlike the internet and text, surprisingly, there's a lot less data. Because when you think about daily returns or weekly returns, if you think about, go back, I don't know, 20 years, how many weeks is that? 20 times 40?
Right.
What? That's not that much. What? 8,000 data, 8,000 weeks. That's not a lot of data points. When you think about millions, billions of data points. So in financial data, well, it seems like you think you have a lot, but we really don't because we haven't been trading things for hundreds of years. It's 50 years, so or
Yeah.
60 years, depending how far back you want to go.
Interesting. Cool. Well, I mean, I don't know. A lot of information there. I'm sure there's plenty of people like, "Whew," like my wife would say, like, "Oh, I'm full." She probably would be like, "I'm full like 20 minutes ago," you know. Um,
I will say this. Yeah, it's the thing that's happening, and we know this is the pace of innovation is accelerating. Okay, and it's something that we've noticed in the last 50. We actually discovered this in the last 50 years with Moore's law. I don't know if you heard of Moore's law.
mhm.
The idea was that computing power doubles every roughly every 2 years, and it seems like it keeps going. And for a while, people thought Moore's law is dead because you get down and the processors are getting so small, you're starting to get problems with quantum effects. So, but guess what? Human innovation, we've been able to keep that pace of innovation, and now with AI, it seems like it's continuing. So it seems like the world is getting faster and faster all the time, and it's actually not it's actually not an illusion. It's actually true It's actually we are, the amount of stuff that gets done in a year is a lot more. If you look back 10 or 20 years, we get a lot more done in a year nowadays.
Yeah.
So things are getting faster and it's getting harder. So in some ways it's harder, but in some ways it's also more stimulating and it's challenging us to learn more and keep on top of things. It's challenging us to really become smarter over time.
Yeah.
I think that's one of the challenges we have as humans, because the amount of data is growing exponentially, the knowledge out there is growing exponentially, and it's really a challenge to to stay on top of it. So we all have to become lifelong learners. We can't say, no, whatever we learned in school, that's it's passe. You have to keep learning. That's the only
Yeah.
way to stay on top of things.
Yeah. So true. So true. Well, awesome. Thank you for your time. Enjoy the weekend coming up. I don't have any
Thank
other
you, Mike.
questions. I don't know if you have any questions, but yeah, I think we're good.
Yeah, thank you, Mike. Thanks for having me. It was a real pleasure. Glad to speak with you, and enjoy the weekend. Enjoy the rest of the summer. It's just a few weeks left before my kids get back to school, so it's like it's gonna get back to the real world. Let's just say. Yeah, exactly, exactly.